Hello and welcome everyone to another weekly market commentary from StashAway. With us, of course, our Chief Investment Officer, Freddy Lim. Hey, Freddy.
Hey, Philip. Good to see you again.
Good to
How are
see
you
you
doing?
as well. I'm good. How about yourself?
Well, I'm well and alive and kicking well, so no worries here.
Well, I wanted to take some time today and actually look back a little bit, right? We had obviously it's been a crazy year in all aspects, but if we reflect from when we were talking together in mid-March, right? It was very different to what we have now, and obviously markets have recovered phenomenally. Making all-time highs, especially in the tech sector as well, right? I would like to maybe give the audience a little bit of a recap, what was this recent market correction all about, and put it also in the right perspective, right? So maybe you can take some time here and do that for those listeners.
Well, it's always after the fact that we get entertaining stories about what causes the correction. But nobody actually cared to talk about, in the first place, we have a huge amount of gains. They blame it on rampant buying of call options in the retail space. They even blame some companies who's buying massive amount to the tune of $50 billion, and that influenced the market. I think the market is a lot bigger than that. So it's important to, regardless of what people perceive as the driver of the drop this month in tech stocks, it's important to go back and look at to put the correction in the right perspective. And the right perspective is we have a huge amount of surge in gains. We're giving back only a small fraction of it. So just to give you a sense, the technology sector on average in the US has gained 80.9% since 23rd of March, the low that we have seen during COVID-19, when it went global beyond China. So 80.9% as of the end of the closing day of 2nd September, right? Then right after that, we have the correction. The market gave back 11.1 percentage point on average for the tech sectors. 11.1 divided by 80.9 is 13.7% of the gains that we have got so far. So again, this is just giving back. It's sentimental for sure. People are taking profits, but it's not fundamentally driven. It's positional. It's positioning driven.
Yeah, thanks for that explanation, Freddie. With us talking already about this little small correction that we saw here in the tech sector, right? In other news, global economies are starting to improve, right? And I think the indicators that you and the investment team look at on a daily basis, right? They are starting to show some positive signs. Especially like China, right, is I think the only one still with positive growth this year, but all the other ones as well. Do you want to dig into that data a little bit more?
Yes, at StashAway, we look across continents and countries and economic regions, and we have computed a StashAway global growth aggregate index. But if you look at that versus China, US, and Europe, there's the same story, that the contraction in output, so the negative growth rate, is becoming less and less severe. So in terms of year-on-year change, you're seeing negative numbers, but they're becoming less and less negative. They're bouncing back. Now, as you mentioned, Philip, China is the only exception with positive growth. And we have looked at leading in the more accurate indicators, such as the Li Keqiang index, because people are always suspicious of the official data, and the vice premier himself has come up with something that's based on freight volume, bank lending activities, and electricity usage. That index is a more accurate profile of the state of the economy, and it's actually the only country in the world that we've seen now that has a positive growth rate, and that's China. Being the first to contract the disease and the first to ease mobility restrictions, you've seen consumption's gone back up quite substantially in China. Manufacturing has outperformed economists' forecasts in August. So that's just overall a coming together of a lot of stuff that's very good for China. The only thing that's missing now is to wait for a confirmation for the unemployment rate to finally come down. It hasn't happened yet. It may happen next.
Yeah, and I think those are all good signs also of what this might mean for the other geographies in the world once they come out of the more lockdown scenarios that they're all in. So let's get to some questions of our listeners. For anyone that's listening for the first time, if you want to have your question featured here and answered by Freddy himself, please feel free to put them down in the comment section below, and the team and us will pick them out and ask them on air. So Freddy, let's go with Charleston Lee's question. It's a topic we get quite a bit, actually, right? It's a topic of ESG. He's saying, hey, Freddy, given the rise of ESG, right, in terms of people asking for it or interested in it, would you consider incorporating or implementing an ESG portfolio in the future?
Well, let me put it this way before I deep dive on it. We do have an ESG scores that we maintain internally for all StashAway portfolio. We don't call it ESG because, it doesn't mean that you invest in ESG, you get performances. In fact, if you look at the past experience with solar panel, when the government gets involved and start putting standards, and it really hyped that particular sectors and make things overvalued, and performances were awful years after. So the way StashAway does it is to say, well, we choose funds, we continue to optimize them, it's globally diversified, they're efficient, but we also take care of our scores in ESG. So that at least we know that we are scoring well, right? So let me put it this way. There are currently two most trending standards in ESG. The landscape is still emerging. There's still a lot of fuss, a lot of noises around it, but the MSCI and the Morningstar are two of the mainstream ones. And when we look at the score that's already implied on our current portfolio, we look at both standards. And MSCI could be a bit more harsh on emerging markets and China, but the Morningstar looks at it very differently, could have the opposite score for China. So you get a lot of that, and you need to look at a combined rating. And I'm pleased to say, on a combined rating approach, combining Morningstar's and MSCI's rating for the ESG we are actually investing in, StashAway portfolios are actually scoring somewhere between 3 to 4 out of 5, depending on which particular portfolios. So we have an average of 3.5, roughly. That's a pretty good score for ESG without being ESG. So we are aware of it. We are conscious of the need to be to support sustainable investing, and but curating a product just on ESG is very different from having a portfolio that's diversified. And I think the two is not the same.
No, absolutely. So thanks, Charleston, again for asking that question. And if you want, we're actually having the head of ESG investments from BlackRock on our podcast here in the near future. So keep a lookout for our podcast in your best interest, and follow it and subscribe so that you get notified when that podcast episode will drop over the next few weeks. So thanks again, Charleston. Let's go with another question from the audience. KP Lowe, he was saying, hey, Philipp and Freddy, keep up the good work. I have a question regarding the commodities allocation in the portfolio, right? Would you consider using GDX as part of the allocation instead of gold bullion? And for people who don't know GDX, maybe you can also explain what GDX is.
Thanks, KP, and hi to KP. And GDX is basically a gold miners ETF, so it tracks the stocks of gold mining companies. I would say that it is somewhat different from the gold bullion itself, which is a protective assets vital for portfolio insurance. What I think that gold miners, when you invest in it, you have additional risk factors to consider. Other than the physical bullion itself, you are buying the sort of you're betting on the exploration success, right? Because the mining companies, they do have to invest in geological studies. They have to take chances at times. It's a probability game as to whether the area seems to have gold, but how deep is the reserve? There's a lot of science, but there's also a lot of chance. So your long exploration risk here, and also how efficient the gold mining companies are managed, and like in terms of its cost, right? So for example, the cost of mining the next ounce of gold has really went up 3 to 4x in the last few years. Out of the $1,940 of gold price, I think it's still there. $1,100 is actually going to cost of mining gold, and that cost can matter negatively for gold miners. Whereas for gold price itself, it serves as an anchor as to you have a base case for gold, right? It's expensive. But for the gold miners, it could be a cost to producing it. And so there's a lot of factors to watch out when it comes to gold miners. And I think Warren Buffett, he was investing in gold mining companies, but he went after specific companies with specific profile. And as you know, good old Warren Buffett tends to change management, turn things around, then sell it off in the public markets. It's quite different from being invested in everything under the sun with a particular ETF. So I would say there's a lot of factors that makes it very differentiated, and you need to consider the additional risk before you invest beyond the gold bullion.
Yeah, absolutely. Great, thanks, Freddy. With that being said, we'll wrap it up for today. We do have a few webinars coming up, as always. In Singapore, we have an investment basics seminar coming up. That's actually on the 23rd of September. That's a Wednesday from 7 to 8:30 p.m. As always, please feel free to sign up with the link in the show notes or go to our website. You'll find that under Academy there as well. In Malaysia, we have also a webinar coming up. It's called How to Invest the Right Way with ETFs. So you learn all about investing with ETFs, how to pick them, how, what Freddy and the team are doing in terms of screening them. So you learn all about that. That's on the 22nd of September. That's a Tuesday, 6 to 7. Again, sign up link is down below the video. For everyone else, and Freddy, good to see you. We'll hope you enjoyed today, and keep the questions coming. And see you next week. Bye-bye.
Ciao.
Ciao. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.